portfolio risk analytics. Here mainly our aim is to enable this platform for any beginner user to understand stocks better and understand how can they invest better and plan their portfolios better. Also with regards to the current financial stock prices, incorporated with the current news and geopolitical aspects as well, and how the sentiments in the news affects the particular portfolios. So right now for the first page we have two modes, user mode and a technical mode. User mode will be more centric for any layman trying to figure out what kind of analysis will be given and will be very action based. A technical mode will be in more detail, trying to understand the working of the project from a data science pipeline perspective. So right now with the user mode, we can first select the kind of portfolio that we have. Right now we've divided our portfolios into four types, that is geopolitical, tech, balanced and conservative, and have tickers for every single type. We can select or deselect any type of stocks that we want to choose. Then we can also set up the kind number of stocks that we want for every particular ticker that we have chosen and an analysis target date. Now this analysis target date is made in such a point of view that it will make sure whenever it goes through the news aspects, it will make sure that the news only to this date and before this date are considered, so that there is no data leakage of any future dates in it. And then we will run our machine learning synthesis on the basis of this information. So as we can see is that on the basis of the current portfolios that we have given, our shock signal received was high. That is, and our advisory engine in short is telling us to reduce our hedge fund in the particular types. And the mapped archetype that we had gotten from a simple rule-based categorization was that tech, and our risk profile was geopolitical sensitive, which states that our risk profile has mostly been affected by the geopolitical aspects of it. Then we also have a layer of AI justification. Now this is an XAI layer that we have added. The viewer can just see in brief what kind of shock was detected and with what kind of volatility. If you want a detailed analysis, we can also see the same with justification from the machine learning models. And we can also see the top 3 performing tickers in this interactive dashboard for every single point that we have taken. Now if we want to switch to the technical mode, here we are going to understand how the 6 machine learning models that we have applied to it work. On the left, we see a radar map that shows how all the 6 algorithms work together as an architecture. Now, since we see that it has been most expanded in the group cohesion section, which indicates that for this particular type of portfolio, this is the model that is playing the most weightage in the combined architecture of all the 6 models. Then the first model we got as the model shock detector for a 0.82 accuracy score. Our goal here for this model was to predict that if a major market drop is likely to happen tomorrow or not. Then for the second one is that a stabilization timer. This is something which is dependent on the first model, that if a shock is detected, how much time will it actually take to stabilize? Right now we have gotten our MEE as 2.12 days. That is whatever number that we have given. The maximum change or can it be from plus minus 2.12 days in the answer. Then the third one, we have a volatility forecast where we wanted to expect the price swing based solely on the news sentiment that we are considering. And then the fourth model that we are considering is that the how one particular type is actually affecting another particular type of portfolio. For instance, in this scenario, how is a news domain affecting any other particular domain that we are considering? For instance, any change in the tech domain, how much time will it take to make sure that that change propagates to other domains? That is what we calculate here. In the fifth model, we are trying to understand what is the domain sensitivity that we have for a particular portfolio. That is, for the portfolio chosen, how strongly it reacts to a specific news type, be it financial, technical, or geopolitical. And in the sixth model, we have a behavioral grouping where we understand by simple clustering mechanisms what kind of portfolio is it better grouped for. So here what we are trying to see in the research bridge is how our mapping is being done from the EDA and the hypothesis questions that we had stated to the machine learning models that we have integrated. And here we see our EDA that was for the calculated for the given data. To see it briefly for the first one, we have the volume of articles that were scraped for every single type of domain of news, green being financial, red being geopolitical, and blue being technology. The second one that we see is how the current distribution of data is being done. As we can see, mostly every single data distribution follows a normal distribution pattern. The next we have one for the sentiment score distribution and panic detection. So here as we can see, the red region in every single scenario denotes the panic driven region for every single type of domain. Here we see a correlation coefficient heat map to understand how every single type of portfolio is correlated to every single other type of portfolio. And similarly, we have the ones here seen for shock absorption. Now, this one has been done with respect to geopolitical shock, since that was the most predominantly affecting sentiment that we had calculated. The other one we have done for a stabilization timeline to understand how every single type of portfolio and what is the differences in the stabilization time for every single portfolio that is being observed, with a mean of 2.12 that we had calculated according to our model before, being the standard deviation allowed for every single date calculated. And then we have the predictive power of each news, where we are able to understand that for every single type of portfolio, be it balanced, conservative, geopolitical, or tech, what kind of news domain dominates that particular portfolio. And here we try to understand a 60-day correlation when we are trying to compare the tech returns versus the tech sentiment that was calculated on the basis of Roberto transformer that we had utilized. Flow. In ML Flow, essentially what we have done is we have compared the results of the machine learning algorithms applied for the two data sets that we had worked on. The initial data set, which consisted of a 1 month scraping period and a total of 18 data points or working days found, versus the new version where we had close to 1,332 data points scraped over a period of 5 years. So what we realize is that since we improved the data capacity by 74 times, what we see is that there were 10 total optimizations done. That is, in general, 10 metrics were improved because we improved the data sets volume that was done. This helped us reduce the data starvation problem that we had faced with the 18 data set point. What we also had done is that in the initial sample of n is equal to 18 data points, we did not observe any historical shocks. However, when we expanded our data set, we realized and recorded 114 shocks. What we see right now is a operational timeline volatility capacity journey. This is essentially an interactive time-based module where we're able to understand how the fluctuations are being done based on the time frame that we are choosing. Here we also realize that if we keep a wider time range, we are able to see more fluctuations. However, if we see a very small time range, the data tends to be very similar and with no peaks or valleys, thus did not allowing us to properly apply the machine learning and statistical models to the same. What we have right now here at the left is a map to just simply compare the initial and the later points and how the six models work together, not only just as model but together as an architecture. The red data points are the previous version where n was 18. We can note that the structure here is very unorganized and not a proper topology is seen. Whereas in the blue version, we see that is the one with the latest one, and we understand that the most change can be seen across the cross-domain lag predictor recovery prediction axis. At the right side, we see that for every single model, what was the percentage of the improvement. So we realized that the portfolio clustering silhouette and sentiment volatility had the maximum improvement when a data set was improved and increased, thus proving that these two models are the most data hungry models. In general, right now, below this, we have every single model, the baseline it had, how much it improved, and by what percentage did it improve. This is for shock classifier, cross-domain lag predictor. Now in recovery predictor, even though it is our status being shown as regressed, what we realize is that because of the initial data, recovery predictor was based on the working of the shock predictor. Now, because the data set was very small in the initial one, there were no shocks being observed. Thus, the recovery period for those shocks was by default 0. However, when certain shocks were observed, a recovery period of more than 0 was observed. So, statistically, it was found that 0 is less than 1 or 2 or any other recovery periods found, and thus it is being shown as regressed here. But what we are seeing here is simply a real-time evaluation of the models that we have applied with the improved data set. The rest we see risk scorer, portfolio clustering, and sentiment volatility regression. All these have been improved because of the expansion of our data set and improvement in the timeline of the web scraping done.